Hey guys, it's Eddie here from Deline Property. Today I want to do a quick video talking about don't get analysis paralysis. And what I mean by that is I speak with a lot of people on a day-to-day basis, and a lot of investors and I guess clients of mine, they want to build a property portfolio. They want to get 10 properties. You know, they saw what I've done with building my own portfolio to 14 properties by the time I was 26, and they want to do something similar, or basically grow a portfolio to increase their wealth over time. This video is about not getting analysis paralysis, and I see this on a day-to-day basis with clients. Say for example, I'm talking to the client or showing them a property or talking to them about property, for example, and they basically overanalyze the property deal itself. With buying property, I want to stay to 3 to 4 main key factors, and those are, I'll go through them really quickly, is buying below market value. I always want to pick up a property that's a bargain. I want to pick it up below what it's worth by means of a bank repossession, an urgent price reduction, or an off-market property. So I always want to pick it up below market value. Number 2 is I want to have it in a metro area. So it's got to be within, say, an hour of Sydney. It's got to be within 30 minutes, 45 minutes of Brisbane, Gold Coast, Melbourne, whatever it is, within an hour radius of a metro city. So I don't like buying in, regional areas and all that kind of stuff at this current stage. I like to stick with metro, very basic stuff. So it's below market value, it's metro, and yield. Yield or cash flow, it's got to have a really high rental yield. It's got to be able to support itself pretty much, more or less. So it's got to have a 7%, 8% rental yield. Can be a little bit less, but it just depends on the deal itself. And of course, growth, it's got to be able to grow in value. And basically, I shouldn't even probably put that on the board, because if it's in metro area and you're buying and holding for the long term, you're going to get growth if you're buying in a metro area. Just plain and simple. Whether you hold it for 5 years, 10 years, 15, 20 years, 30 years, you buy in a metro area, most likely in 20 years, it's going to be worth a lot more than what you paid for it. Getting back to it, don't get analysis paralysis. I look at these 3 to 4 main key points, and where I find most people go wrong, they overanalyze a deal. Say for example, you got a house and someone's worried about, is it close to a train station? Well, for me, basically speaking, just answering that question right there, if it's within a metro area, 45 minutes, 30 minutes, well then most likely it's going to be near a train station. Whether it's distance, I don't look at that stuff that in depth. Like, I don't factor that in. If it's below market value, it's got a good upside for growth, rental yield, metro area, I buy it, I jump on it immediately. Picking up properties below market value, I want to be able to make sure that the last 3 to 5, maybe more comparable sales are much higher than what I'm picking up the property for. So if you're picking up a property for 300,000 and the last sales were 340, 350, 360, and you get one for 300, well that's an amazing deal. And if it's renting out for 450 a week, well that's, and it's in a metro area, I jump on the deal absolutely. I've heard lots of objections over the years. Some people say, if it's got a pool, I wouldn't buy it. If it has a pool, I wouldn't buy a unit or a townhouse. I'd only buy a house because of the land, and you have to pay strata fees and all that kind of stuff. I've bought houses, townhouses, units, I've bought them all. I don't prefer houses over units. I don't prefer one over the other. It's whatever's going to make the most money at the end of the day. I cannot make it more simple enough. Another one would be, an objection I hear, if the property's on a main road, I don't want to buy it. Well, put it this way, if you're buying a property on a main road, if you bought a property 20 years ago on a main road over Sydney, Melbourne, Brisbane, 20 years ago, is it worth more today? Yes or no? 20, 30 years ago, is it worth more? Absolutely it is. So if you pick it up, a property on a main road, and it's below market value, it's got a high rental yield, and it's got upside for growth, why wouldn't you buy it? Just because of the fact that it's on the main road. It's the tenant that's going to live there, not you. And that's what I always look at. It doesn't matter what the property's like inside, it doesn't matter if I wouldn't personally like to live there, it's not about that, it's about making money and about growing the portfolio. So that's just another example. Another one would be if it's in a complex, how big is the complex? So say for example, it's a townhouse. I spoke to people and they've said, oh, we'd only buy in a small complex, such as 5 townhouses in the complex or 10 townhouses in the complex. I bought in townhouses and units in complex that are small, 5, 6, 7, 8, 10 units or townhouses in a complex. Then I bought properties that have 100 in a townhouse complex or a unit complex. There's no right or wrong. There's always the land size factor that goes into play, but plain and simple, if you're picking up an amazing deal and it's below market value, it's got a good upside for growth, it's got a good rental yield, it's in a metro area, why wouldn't you buy it? You might say that it's your portion of land size is smaller or whatever the case is, but to me it doesn't matter. If it ticks the boxes and it's making money, why not buy it? Let me ask you a question. If you bought a property that was in a large complex in Sydney, Melbourne or Brisbane 30 years ago, and you held it for 30 years, would you have made money on it? Yes or no? The answer is yes, which of course it is yes. Then there's no problem with buying one of those properties that's in a larger complex. So, I guess these are the kind of things I narrow it down to three to four key points. The other stuff, look, I do take that kind of stuff into consideration. But if you're looking at growing a portfolio, 10 properties, 15 properties, and you're looking at making a serious run at growing a portfolio, not messing around and buying 1 or 2 properties, and I speak to people, they think they're experts, they've got 2 properties. Like, what the hell are they gonna know? Property investing isn't about buying 1 or 2 quality properties or just sitting on them for life. It's about getting yourself in a position that gives you financial freedom. That's my definition of property investing and moving forward. So you've got to build a portfolio of 5, 10, 15 properties if you actually want to get there. You give 1 or 2 properties, depending on, it's not going to do anything, from my opinion, in the short term to get you to where you want to be. Maybe I've just got bigger goals and bigger ambitions, but you've got to build a portfolio. Buying 1 or 2 properties, messing around, getting analysis paralysis isn't going to do anyone any good. It's just going to hold you back. I've seen lots of people miss out on amazing opportunities. I myself missed out on amazing opportunities in the past because there was too much analysis paralysis, focused on the small things that didn't matter over time. So I hope this video has helped. Don't get analysis paralysis. It's good to analyze everything, but if you analyze too much, it's like being a parachute. If it's open too much, it's not going to work. You've got to have your mind open only a certain amount and let the stuff that matters most affect your decision, not the stuff that doesn't matter. So thanks for watching, guys, and I'll catch you next video. Bye.